Uber fragile business. Uber has always struggled to become profitable from day one, with the idea that it would eventually become economical. However, the larger Uber grew, the more money they burned. In 2019, 2020, and 2022, Uber burned as much as $10 billion per year. In 2023, Uber started putting in a few profitable quarters, but they came in with a bigger loss than analysts expected, coming in at $654 million. This loss was due to poor performing investments and legal settlements, but it shows how fragile Uber's business really is. One downturn in the market or a few legal settlements is all it takes to make the company wildly unprofitable, which makes sense given their thin margins. Uber's gross margins themselves only come in at 40%, while most of their tech peers have net margins of 40%. Meanwhile, Uber's net margin barely comes in at 2-4%. So all it takes is a few percentage swings in ridership cost per mile, surge pricing, or incentives, and Uber is back in the red. The taxi business was one of the most profitable businesses in the world, not for drivers but for taxi medallion owners. Taxi medallions were used to limit the supply of taxis, making them a race to the bottom. Uber entered the market by democratizing it by blatantly ignoring traditional taxi regulations and creating their own market-driven, purely by supply and demand. This won them a lot of pushback from local governments and the traditional taxi industry. In 2010, San Francisco issued UberCab, which included penalties of up to $5 per instance of UberCab's operation and up to days in jail for every day UberCab continued to operate. Eventually, Uber made it past this pushback with the help of public support. Uber initially didn't face economic issues because it wasn't directly competing with taxis. They offered a premium service with black Lincolns that cost 50% more than taxis, and Uber followed suit by offering their own version called UberX, which was 35% cheaper. As a low-margin business, Uber and Lyft quickly reached the bottom, and they began subsidizing rides heavily. The fundamental problem with all of these ride-hailing businesses is that when tech doesn't scale, it doesn't become more profitable. Tech has been profitable over the past decade due to its ability to scale. In the 80s and 90s, most tech companies had physical products, but in the 2000s, pure software companies like Google, Facebook, Salesforce, and Adobe were able to serve an unprecedented number of people. WhatsApp only needed 50 engineers to scale to 900 million users, meaning each engineer could serve 18 million customers. This unprecedented leverage allows software companies to scale so fast and be so profitable. However, companies like Uber, Lyft, DoorDash, Grubhub, and Instacart do not have much engineering efficiency. For every ride, you still need a driver, and Uber's fundamental mechanics remain the same. To solve this issue, they employ over 30,000 people, most of whom are Bay Area engineers earning multi-six figures or even seven figures. Uber has experienced well over $35 billion worth of dilution over the years, with the company now worth $137 billion. This is a testament to how poorly Uber has scaled. The company expanded supply by letting anyone be a driver and subsidizing rides to maximize market share. Uber Eats accelerated the burn, making it difficult for delivery-based restaurants to work. Food delivery platforms like Uber Eats and DoorDash seem like a cool concept, but they introduce an extraordinary amount of friction and overhead when connecting random customers with random drivers with random restaurants. Customers end up paying more than ever, restaurants end up earning less, and platforms like Uber and DoorDash burn all their money on expansion and engineers, while drivers get paid next to nothing. Not all app-based businesses scale the same way, and Uber is no better example than other companies. Uber's current struggles are not surprising, as many investors foresaw these problems from day one. Mark Cuban, an investor in Travis' former Uber founder and CEO previous business Red Swoosh, passed the opportunity to invest at a $10 million valuation due to three reasons. taxi regulations, economics, and profitability. However, Mark regrets not investing, as he would have made a killing despite these issues. Looking forward, Uber needs to put up solid earnings to justify its sky-high valuation of $137 billion. At a P/E ratio of 20, Uber would need $6.85 billion worth of net income to justify this figure. At their current net margin of 3.6%, Uber would need to grow revenues to $190 billion to take home $6.85 billion. The most realistic path would be to grow both revenue and margins to something like a 10% margin at revenue of $60 to $70 billion. Uber is an extremely complicated platform compared to its tech peers, dealing with the global map, live GPS location of over 6 million drivers and 150 million users, search pricing, routing customer driver, and restaurant onboarding, and more. It consists of 4,500 stateless microservices that are updated more than 100,000 times by 4,000 engineers every single week. Uber also has to worry about driver safety and driver liability protection, and not accidentally starting a movement against Uber. In order to keep growing, Uber would need to post numbers even better than that. Just because they post bigger numbers doesn't mean they are any more stable. Uber's bottom line will still be at the mercy of even the smallest fluctuations within the ride-sharing and food delivery markets. This makes Uber one of the most fragile tech companies in the world. Let's also not forget Waymo driverless cars and Tesla robo-taxis, which will be competing in this space. Nouriel, Gino, Yazdinian.